Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal, and today again we have aligned a packed show for you today where we'll be talking about various investment instruments and your investment strategies that you've aligned for your financial goals, and we will also answer your mutual fund portfolio queries. So just in case you have any question which is related to your financial goal or your investment strategy, you need our experts' help. You can send across your questions on our WhatsApp number, which is 865-797-4571. We also have an email ID where you can send across your queries. The email ID is themoneyShow@etnow.tv. All right, so let's begin the show. And today on the Money Show, where we bring you sharp insights from the leaders shaping India's financial future. Joining us today is a name that needs an introduction, Mr. Sanjiv Bajaj, Joint Chairman, Managing Director of Bajaj Capital, one of the India's oldest and most trusted financial services firms with decades of experience in wealth management and financial planning. Mr. Bajaj has been at the forefront of helping Indian investors navigate through markets and with confidence and clarity at a time when the Indian market at a healthy level, global volatility is rising, domestic consumption is showing resilience. We sit down with Mr. Bajaj today to decode the bigger picture. And what are they telling their clients right now? What are they positioning? How are they positioning their portfolios in a year that has tariff uncertainties, geopolitical stress going on, rate cycle shifts and sectoral churns? And what should the retail Indian investor really focus on in 2025? We will explore all of this. And Mr. Bajaj, thank you so much for joining in today. And the very first question to you will obviously be about, how do you assess the current state of the Indian market? Because especially considering the recent trends and global volatility, what are the key drivers according to you for the Indian markets today?
Overall, Indian story is very attractive and very good. And I think the global trends, yes, there may be some short-term pain for the country, but long-term is going to be amazing for India. Because as manufacturing moves to India, India is going to become a very important viable supplier to US. This trade war, India can be one of the biggest beneficiary, and that benefit will definitely come onto the stock exchange. But I'm not saying that yes, there's not going to be any pain. There is going to be pain, and especially in sectors like IT or some other sectors which are export oriented. There is going to be some amount of pain, and whenever you get a chance, dips were there. It's a very good chance to buy. So I think long term, if you have a 5 to 10 year horizon, India is a great story. If you've got a shorter term horizon, I would recommend next 6 months be focused on India specific stocks which are more dependent on India. Be focused on more large cap, blue chip companies, solid companies. Where there are some shocks, they are able to absorb them better. So this is my overall basic recommendation at the moment.
Are there any specific sectors or asset classes that you believe in the best opportunities right now? You did mention domestic facing sectors, that can be good for investors. But then what are you recommending to your clients in terms of best opportunities, both retail and institutional investors?
As I've said, look, what we are recommending to our investors is the large cap and the large cap stocks. And I think also we are recommending to our investors that look at some debt. Because, I expect as the manufacturing will go up and there is some trends that India will try to reduce its interest rates, which will offer some benefits on the debt fund investments. So it's a good time to look at debt funds also. The only place where we are saying that please be wary is the small and large cap, unless you are small and mid caps, unless you are coming in for a long term. So if you are doing, a long-term investment, then we are quite bullish on flexi caps, and we are quite bullish on multi caps. The reason I'm saying multi caps makes sense for the longer because your money is getting allocated between small cap, mid cap, and large cap. And then there is automatic rebalancing, which is being done by the fund manager on your behalf. So that will add a great alpha in the 10 years or if you have a long-term portfolio in mind. In case of sectors, domestic consumption stocks are amazing. They are very, very good. Financial services stocks, it's very good time to be in financial services stock, very stable. They are going to be good. Even the pharma, I think there is an opportunity out there, although the tariff scenario is not clear, and a lot of Indian companies are very dependent on supplying to US, and their supply chain is also slightly constrained, but they can be an opportunity there. But that is obviously slightly higher risk. So, today, if you are a layman investor and doing a SIP, then I think flexi cap makes and multi cap makes a lot of sense. If you are slightly conservative, then large caps. It's a good time to be in large caps. So this is our basic recommendation.
SIP is definitely the safest route to participate in equity markets, especially if you're doing it through mutual funds. And you mentioned flexi-cap and multi-caps being a category where you can be diversified if you're buying a mutual fund. Any specific trend that you've noticed in terms of SIP stoppage? We've seen the ratio going up, but the industry is still not admitting that it's very concerning. What are your views in it? See, the SIP numbers, everyone that we see coming in from AMFI are a little less than 26,000 crores, but the storage number is rising since December. It could be a typical investor behavior during these volatile times. Investors might be just shifting their money, or maybe not confident with the equity market, especially the ones who've just entered 2 to 3 years back. So, in your experience, what is the trend that you are looking at?
Yeah, the trend is definitely there. There is a lot of SIP stoppage, but that is more happening to advisors who have gone to clients who have gone direct. See, what has happened is that DIY investors had increased quite drastically, and there is nobody there to guide them. There's nobody there to hold their hand when the markets were crashing, or the small cap and mid cap funds were not performing. There was a correction happening. So, these are the times when, if you have got a good advisor, he understands what type of funds that you need to be in, whether it's time to top up, it's time to invest. Like when the markets crashed, we were telling our investors, okay, look, this is the time to put in your money. If you're keeping any money on the side, or you can transfer money here. So when people are DIY, there is nobody to guide them. They are getting scared. Nobody is telling them. So this is the very, very classic story of behavior finance, that if you remain invested in the market for 10 years, then there is almost a 99% chance that the markets will give you return. But only 8 to 10% of the people actually make money, because, they get scared when the times go tough, which are the times to buy. And when the times are very good and the market is very high, they get over bullish and they over invest in the market. They take loans, they take higher risk. So yes, SIPs have stopped, but I will tell people that, look, this is not the time to stop your SIP. This is actually the best time to do the SIPs, because volatile SIPs are meant for volatile markets, and the markets have been volatile and they will remain volatile. That's my personal view. But don't get scared. Have a long-term view. Keep investing. And because overall India's story is very, very good. India's growth rate, GDP growth is still amongst the best in the world. So there is a lot of value and a lot of wealth to be created in India. Be a part of that story.
Talking about investor interest in mid-cap and small-cap category, any significant trend over there? Because we've seen a lot of money shifting to flexi cap, investor interest in small cap. If you have to compare with the previous month, slightly it has gone up as per the ANFI numbers. But then something in specific that you are looking at?
Yeah, there is definitely an overvaluation in small cap and mid cap stocks even till now. Because so if you look at the PE ratios, there has been a huge amount of correction, and there can be a huge amount of pain. Whereas in a large cap stock, you are sure that it will not fall more than 20-25% in the worst case scenario. But yes, then overall, when it goes up, also it will not go crazy. It will not double or triple. So there is a limited downside, and there is a slightly limited upside opportunity there. Whereas a small cap can give you a huge downside, can be huge. It can be 60-70%. Upside can also be huge. So there is definitely a much higher risk, and there is always investing is a game of risk and return. Higher risk you take, higher return you can get. Same is the higher loss you can get. So definitely, but I would still say that this is, when markets are very volatile and the global economy is seeing a lot of uncertain things and there can be a lot of risks which we can't see today. I would say that please be wary of the small cap and mid cap. Be scared there, especially small caps. Be focused on higher quality large cap stocks with proven stories, proven consumption. And the opportunity here is that most of these stocks have just performed in the last 2-3 weeks. Otherwise, these stocks were not performing. Their PEs were much better than even the small caps. So why would you not put in your money here? The upside potential is much higher in the large cap stocks today.
Um, Talking about tier 2 and tier 3, where we saw, the B30 basically, we saw a renewed interest of investors coming in from there. And since you mentioned direct SIPs and there's no one to handhold them and guide them, post COVID, we've seen a surge of investors coming from those areas as well. Any significant trend that you are witnessing over here and in last couple of months, that area or those part of investors going away from equity markets because the kind of market run they must have seen in 2 to 3 years, it's not the same anymore. So maybe the interest could have died down. Any specific trend over there?
No, I think the markets have changed for good. The India story is now, through you guys and all the media is there available and known throughout the country. And today people are very informed. Today it's not that, they are big city where people knew a lot and there are smaller cities where people don't know. Knowledge has become very universal. Everybody has good knowledge. Everybody has access to good programs. Everybody has access to good information, good tools. So I think they are smart investors which are there from the smaller cities who have come into the market. They understand how to tackle this market and they are going to remain there. But then they are also from the larger cities. They are investors who have just entered for the sake of entering because their friend was doing it or somebody recommended this. They are totally DIY. They are trying to direct, save that 0.5%, and yet they are losing a big amount on the return. So I think the difference is not between the small cities and the large cities today. Yes, there are people from every city, who don't have a right financial advisors, who have been, I'll say, penny wise, pound foolish, that today they are getting into the markets without the right advice, without the right handholding. They have to find a right financial planner to be with them. Who has to make them understand what are the basic core principles of investing. How do you plan for a goal? How do you prioritize a goal? And then how do you define your risk as per the goal and how you start investing as per that goal? And if you're doing that and you're clear, okay, look, this is my goal, this is my children's education, this is 12 years away, this is my children's marriage, 17 years away, this is a house I want to buy 6 years away, then you can take much more rational, much more productive decisions. Yes, the role of an advisor is that, okay, he has to, at the end of the day, select funds for you, which are likely to do better in this scenario than what we are looking at. So his job is to hire and fire the fund managers for you, which are the right fund managers. Another major problem is that people invest looking at the past. But that doesn't work. But if you ever look at a fund which has performed very well for the last 1.5 years, will not be the best performer for the next 1.5 years in 90% of the case, because whatever the fund manager's philosophy was that this will work has already worked and it has become a thing of the past. Okay, so it's in financial markets, the same thing doesn't keep working. So we always have to be very careful that who are we investing with, what's the fund core philosophy. If the philosophy is right, then every fund manager who's good will have his day.
All right, Mr. Bajaj, I think that will be all. Thank you so much for taking our time and explaining our viewers and in fact helping them form their financial portfolio strategies. Thank you so much.
Thank you.